Picture this. You've been investing for 2 years. You've got a decent portfolio, some index funds, maybe a stock or two you're proud of. And every single quarter, you watch the news tell you dividends were paid out, but you personally feel nothing. Because 3 months is forever when rent is due every 30 days. Here's the contradiction nobody talks about. The market is handing out income constantly, but most investors are set up to receive it once a quarter, if they're lucky. Meanwhile, there's a small corner of the ETF world where payouts happen every single week. Not quarterly, not monthly, every 7 days. Now you might be thinking, Finn, that sounds like one of those high-risk options plays that'll blow up my portfolio. And that's exactly what I thought too, until I started digging into the actual mechanics. Because here's the thing, some of these weekly paying ETFs are backed by the US government. Others sit on one of the most iconic companies in American history. And yes, some have yields so high they'll make your jaw drop. But those come with trade-offs you need to understand before you touch them. Stay with me, because by the end of this video, you'll have a clear picture of 5 weekly dividend ETFs, ranked from the safest to the most aggressive, and exactly which one might belong in your portfolio. My name is Finn, and I spend way too much time thinking about personal finance and investing. If you're someone who's tired of watching your money sit idle between quarterly dividend checks, and you want to understand how weekly income actually works in a real portfolio, make sure to hit that subscribe button and give this video a thumbs up if this helps you out. Let's get one thing straight before we dive in. Your net worth on paper does not pay your grocery bill. Cash flow does. The average investor thinks about investing in terms of account balance, but the investors who actually feel financially stable, the ones who stop living paycheck to paycheck, they think in terms of income streams. How much money is coming in and when? Most investments pay out so infrequently that you never connect the dots in real life. Quarterly dividends feel abstract. Monthly income gets more real, but weekly income, that changes your psychology entirely. When $40 drops into your account every Friday, you start thinking differently. This covers my electricity bill. This is my weekend fund. This compounds into something meaningful. And that feedback loop, seeing your money work for you on a regular cadence, is one of the most powerful tools for building long-term discipline as an investor. So let's look at 5 ETFs designed to do exactly that, from dead simple safety to high-octane income. ETF number 1, WEEK, the ultra-safe weekly T-bill. Let's start at the safest end of the spectrum, the Roundhill Weekly T-bill ETF, ticker WEEK. This fund launched in March 2025 and does exactly what it says. It invests exclusively in US Treasury bills with maturities between 0 and 3 months. As each one matures, the fund rolls into a new one. Think of it as a constant ladder. Every rung pays right on schedule. The current yield on WEEK is approximately 3.75% annually. That won't make headlines, but here's the trade-off. You're holding the safest financial instrument on the planet. These are backed by the full faith and credit of the US government. The expense ratio is just 0.19%. Now you might be thinking, Finn, 3.75% isn't impressive, and you're right in isolation, but compare it to a traditional savings account earning 0.5%, or a money market fund that keeps you waiting for monthly interest. WEEK pays you something every single week with essentially zero credit risk. Who is this for? Ultra-conservative investors, people parking cash between bigger moves, retirees who need predictable, frequent income and can't stomach volatility. If you're trying to earn something on your dry powder, WEEK lets you do that without gambling. ETF number 2, MMKT, the safety blanket with a better return. If WEEK is your basic safety net, MMKT, the Texas Capital Government Money Market ETF, is the same concept with a slightly better return profile. Here's how it works. MMKT holds at least 99.5% of its assets in government securities, repurchase agreements, and cash. It follows strict SEC Rule 2A-7 compliance, meaning average portfolio maturity stays under 60 days. The risk profile is nearly identical to WEEK. The current 7-day yield on MMKT is approximately 3.70%, similar territory to WEEK, though the exact figure fluctuates with short-term interest rates. Now you might ask, if yields are similar, why pick MMKT over WEEK? The answer comes down to structure and flexibility. MMKT has a slightly different duration positioning and may capture rate movements differently. It's also useful as a cash equivalent in taxable accounts. The honest picture, in a rate environment where the Fed has been cutting, both WEEK and MMKT have seen their yields come down from where they were 18 months ago. If you had caught MMKT a year earlier, you'd have been earning closer to 5%. That's the nature of short-duration government instruments. They move with rate policy. These two ETFs are best understood as what I call productive parking spots. You're not building wealth here. You're not losing ground either. You're earning something real while keeping powder dry. That's valuable. ETF number 3, BRKW, Berkshire Hathaway's Weekly Paycheck. Now this one's genuinely interesting. The Roundhill BRKW Weekly Pay ETF, ticker BRKW, launched in June 2025. Here's what makes it unique. Berkshire Hathaway, the company, has famously never paid a dividend in its entire history. The philosophy has always been to reinvest capital into businesses rather than distribute it. That tradition continues under Greg Abel, who took the reins as CEO when Warren Buffett stepped down in late 2025. So how does BRKW generate weekly income from a company that refuses to pay dividends? The fund holds BR.B shares and uses total return swap agreements to achieve 1.2 times the weekly price return of Berkshire Hathaway. That slight leverage is what creates the room to fund weekly distributions. It's important to note, BRKW does not sell options. This is pure leveraged equity exposure with distributions drawn from that amplified return structure. The current annualized distribution rate on BRKW is approximately 16 to 20%, but here's where intellectual honesty matters. As of the most recent 19A-1 filing, roughly 100% of BRKW's distributions are classified as return of capital. That doesn't mean the fund is failing, it means the tax treatment is structured to return capital first, which you'd eventually recognize as a capital gain when you sell. The fund is relatively small, around $15 to $20 million in assets under management, so liquidity is something to watch. It's not a problem if you're a retail investor buying a few $1,000s worth, but it's worth being aware of. One potential drawback is the leverage itself. In a week where BR.B drops sharply, BRKW amplifies that loss. The fund could theoretically lose significant value within a single calendar week. Who is this for? Investors who believe in the long-term quality of Berkshire Hathaway's business empire and want to extract weekly income from that exposure while still maintaining equity upside. Just understand the mechanics before committing capital.
ETF number 4, SDTY, Wall Street's daily hustle in a weekly paycheck.
All right, now we move into higher risk territory. SDTY, the YieldMax S&P 500 Zero DTE Covered Call Strategy ETF. The strategy here is genuinely fascinating from a mechanics standpoint. Every single trading day, SDTY sells out-of-the-money call options on the S&P 500 that expire that same day, 0 days to expiration, 0 DTE. The fund collects the premium from that sale. Do that 5 times a week, every week, and you build a steady stream of option income that gets packaged into your weekly payout. The current annualized distribution rate is approximately 24.75%. Here's where it gets really interesting, and where you need to pay close attention. As of the most recent distribution, 100% of SDTY's payout is classified as return of capital. Let me be very clear what that means in plain English. The distributions you receive are not coming from investment income in the traditional sense. They're returning your own invested capital to you in a structured way. That does not automatically make the fund bad. It's a deliberate structure. You're choosing maximum current income over long-term capital preservation. The S&P 500 exposure provides some price participation, but the 0 DTE covered call overlay caps your upside on big updates. This is not a set it and forget it forever hold. It requires understanding. If you reinvest the distributions while the NAV is declining, the math gets complicated fast.
SDTY has about $37 million in assets under management and has delivered approximately 24–25% total distribution income, but the total return picture depends heavily on how you manage those distributions. Think of SDTY as a high-throughput income engine that runs hot. It can do a job, but you have to understand what it's actually doing. ETF number 5, GOLI, formerly GLDY. Gold meets weekly cash flow. Finally, we arrive at the highest yield play in this group, the Defiance Gold Enhanced Options Income ETF. Important update here, this fund recently changed its ticker from GLDY to GOLI as of June 30th, 2026. If you've seen older content referencing GLDY, same fund, new ticker. GOLI sells put options on the SPDR Gold Trust, GLD, to generate income. When GOLI sells a put option on GLD, it receives a premium up front. If gold stays above the strike price at expiration, the fund keeps the premium as income. If gold falls below the strike, the fund is obligated to purchase GLD at the strike, meaning it does absorb downside gold exposure. The current annualized distribution rate is approximately 30%. Now, the original 41.74% yield you may have seen in older content, that was from an earlier period when gold volatility was higher and option premiums were richer. Yields on options-based strategies fluctuate significantly with market conditions. As of today, 30% is where it stands. Still eye-catching, but lower than what was circulating previously. Approximately 91% of GOLI's current distributions are classified as return of capital. One potential drawback, and this is significant, unlike what some descriptions suggest, GOLI does not provide a straightforward inflation hedge. Selling puts on GLD means you benefit when gold is stable or rising, but you face losses when gold drops sharply. The fund's NAV can decline materially in a gold downturn. Who is this for? Sophisticated income investors who actively monitor their positions, want maximum weekly cash flow, and have a view on gold stability. This may not suit every investor and carries considerably more complexity than Funds 1 and 2.
Here's what I want you to walk away with. Weekly dividend income is real. It is not a gimmick. And